Welcome back to the Deep Dive. This is the Talk Tickers edition, and today we're digging into the details of the Q3 2025 revenue conference call for Air Liquide, that's AI.
Yeah, and when the market saw this update, the share price actually ticked up a bit intraday. Mildly positive reaction.
Right.
Which, it signals a quiet confidence. Management was pretty open. They acknowledged operating in a turbulent environment, yet the results, well, they landed pretty much right on expectations.
So the market sees execution, but like you said, that's really where the analysis just begins. Our mission today is to figure out if this performance is really rooted in, let's say, structural strength, meaning their long-term strategy is actually working.
Or if it's maybe just masking some underlying macro weakness.
Exactly. We need to find that definitive signal in the data, especially when we talk about their pretty aggressive multi-year margin improvement plan.
Okay, let's jump straight into the results snapshot then, because they do confirm a pattern of, well, pretty impressive operational resilience, even if the headline number itself looks a bit dull.
Yeah, the headline numbers definitely confirmed an inline quarter. Total sales came in around 6.6 billion.
Roughly.
But the number that really matters here is comparable growth. Revenue grew plus 1.9% year over year on that comparable basis. So maintaining that positive trajectory.
And that comparable growth figure is just vital because it extends right into their core segment, gas and services.
Yeah.
Those sales also grew plus 1.9% comparable basis.
Okay.
Now, the reported growth number, that looked negative, which can be confusing, but that's really just down to currency translation and those energy pass-through effects.
Right, the pass-through.
Yeah. For listeners maybe less familiar, energy pass-through just means the company adjusts revenue to reflect volatile energy prices they charge customers. But importantly, this doesn't really impact their actual operating margin in a material way. The core business itself is still growing.
That distinction is absolutely crucial. So the positive market feeling wasn't just about sales hitting the mark. It was driven by these operational levers.
Yeah.
Management is pulling pretty aggressively behind the scenes.
Absolutely. The first lever is cash generation. Operating cash flow increased a really robust 7% year over year if you exclude currency impacts. Shows they're managing working capital very tightly.
Okay.
But the second lever, efficiencies, that's really the big story here, I think.
Walk us through those efficiency gains because the numbers, they look quite staggering.
They really stepped up efficiencies to 163 million just in Q3 alone. That's a stunning increase, more than 20% compared to Q3 last year.
Wow.
And what's even more telling is the cumulative achievement. Management confirmed they've already delivered 15% more efficiencies over just the first 9 months of 2025 than they managed in the entire year of 2022.
15% more than the whole prior year already.
Correct. So this isn't some cyclical luck. This is clearly structural self-help driving those margins higher.
And crucially, they haven't sacrificed pricing power to get volume. Industrial merchant IM pricing remained highly accretive. It increased above 3% in Q3. And what really stands out to me is that this marks a sequential increase versus Q2. So in an environment where practically everyone is complaining about demand, Air Liquide is showing it can still raise prices effectively.
It really speaks volumes about their contracts and, the mission-critical nature of their products. They aren't selling discretionary stuff. They're selling the oxygen, nitrogen, hydrogen that keeps heavy industry actually running.
Okay, let's unpack this resilience then and pivot towards the strategy. Management's clearly communicating. They're leaning hard on these efficiencies and, massive investment deployment to sort of weatherproof the business against any potential macro slowdowns.
What's fascinating here is just the sheer structural confidence they seem to be projecting into the future. They didn't just reaffirm their full-year outlook, margin improvement, recurring net profit growth at constant FX.
Which is standard, yeah.
Right. They doubled down on their long-term structural goal, lifting the operating margin by a cumulative 460 basis points between 2022 and the end of 2026.
460 basis points.
Yeah. This isn't just a forecast. It feels more like a commitment based on structural transformation that's already underway.
That is a huge swing in margin for a company of this size. It implies massive, really deeply embedded operational changes. So let's look at how they're deploying the capital to actually achieve that goal. Management organized their strategy into 4 growth engines, right? These seem crucial to understanding the future top line.
Yeah, and the first engine is maybe the most strategic, particularly in a high interest rate world. Low CapEx growth.
Right. This is all about leveraging existing assets, essentially squeezing more juice out of their current pipeline network. The best recent example they gave was signing new contracts to supply hydrogen to 2 of the largest U.S. refiners.
And the CapEx.
Minimal investment, only about $15 million US, apparently, just by integrating new compression and distribution gear into pipelines they already have.
See, that's a fascinating capital allocation strategy. High, immediate returns without tying up huge amounts of capital for years. It really speaks to the maturity and the density of their existing network. That's a major competitive moat right there.
Contrast that with the second engine, traditional core activities investment. This seems heavily targeted at structural long-term drivers, semiconductors being a prime example.
Definitely. They announced 2 major long-term contracts reinforcing their electronics leadership. There was a $250 million investment for electronics in Germany, their biggest ever in Europe.
250 million, wow.
And $130 million investment for 2 carrier gas units down in Singapore.
So really doubling down on semis.
If you look at the electronics sector, those investments aren't about quick returns. They're about anchoring these really long-term relationships with global chip manufacturers. They also highlighted growth in their home healthcare business in Spain using proprietary digital and AI solutions. That's where high-tech solutions drive stable, long-term growth in what's usually a pretty low volatility market.
Okay, then we move to engine number 3, which is maybe the most forward-looking, energy transition. This is where they are deploying substantial capital. It signals a genuine belief in the hydrogen future, doesn't it?
Precisely. The prime example here is that $500 million investment for the Alligator project, a 200-megawatt electrolyzer in Rotterdam.
Alligator, right.
Yeah, and this project is dedicated to supplying Total Energies with green hydrogen through a secure long-term contract. These are the kinds of massive transformative projects that really move the needle, looking out towards the 2030s.
And finally, engine 4 is acquisitions, where they use M&A to strategically deepen their exposure in high-growth areas.
Right. They detailed the very strategic $2.85 billion acquisition of DIG Airgas in South Korea.
Big one.
Huge deal, aimed squarely at deepening their semiconductor exposure. South Korea is critical geography, and management noted the semiconductor market is expected to basically double in 10 years. They also did a smaller bolt-on, under $100 million, in India Novair, just to densify their regional presence and distribution network there.
So if you connect this whole investment story, you can really see where that structural confidence comes from. The overall project investment backlog hit a new record high, now approaching $5 billion.
That's probably the most tangible signal of future growth available right now. And when you factor in that major DIG Airgas acquisition, total capital deployment is nearing $8 billion. That is a massive commitment.
Huge numbers.
Absolutely. And critically, their capital discipline seems excellent. Their recurring return on capital, ROC, which measures how efficiently they generate profit from all the deployed capital, remains strong at plus 11%. That's actually exceeding their own advanced target threshold.
Okay, let's transition then to regional performance, because that's often where, the macro mask starts to slip a bit.
Yeah, the Americas were definitely the regional star performer. They delivered strong plus 5% comparable growth, benefiting from startup ramp-ups and also low levels of planned maintenance or turnarounds at customer sites.
Net pricing.
IM pricing was particularly strong there, up plus 4.5% year over year.
That strong performance really seems to suggest the U.S. industrial sector, particularly refining and chemicals, is holding up exceptionally well compared to, say, the rest of the world. But Asia, conversely, presented a more mixed picture.
It did, yeah. Large industries faced significant turnarounds at customer sites, especially in chemicals. That softness was apparently enough to offset the continued positive ramp-up contributions they're seeing in China and Korea. Suggests maybe some cyclical weakness in certain Asian industrial sectors.
And what about electronics? That's been such a consistent growth engine for them. Was it affected by the global chip slowdown everyone's talking about?
Yes, but with some nuance. Equipment and installation, the E&I part, those sales were normalizing after hitting a record high last year. E&I is the more cyclical component. It's selling the heavy machinery, the setup.
Right, the upfront stuff.
Exactly. But the core carrier gases, the actual product they supply continuously, that maintained double-digit growth. Management did suggest E&I sales could normalize around Q2 of next year, which is maybe a hopeful sign for recovery in that cyclical capital spending component.
Okay, that gives us a good runway. Now let's tackle some of the investor concerns that came up during the call, starting with the Q4 outlook.
Right. This is where maybe a little caution creeps in. Management expects Q4 activity to be above Q3.
Okay, positive direction.
Positive direction, yeah. Citing continued strong momentum in the Americas and also positive comparison effects in Europe as tailwinds. However, they remain generally cautious overall regarding the broader macro picture.
Wait a second. If they're executing record efficiencies, reaffirming this huge 460 basis point margin goal for 2026 and investing $8 billion, why the cautious tone? Are they signaling some macro trouble beneath the surface, or is this just, typical management conservatism?
It's probably a bit of both, right?
Mhm.
But I think the key is that their performance doesn't really hinge on macro acceleration anymore. It hinges on executing their cost control and converting that massive backlog. They seem to be insulating themselves.
Okay.
For example, let's look at the helium disruption issue that keeps coming up.
Ah, yes. I expected that to be a major headache given everything going on.
Well, they confirmed the helium market is disturbed, partly due to sourcing issues, sanctions, etc. But management really minimized the P&L impact. They noted helium is only maybe 3% to 4% of their total turnover.
Only 3-4%. Okay.
Yeah, and crucially, they've secured 70% to 80% of their needed volume via long-term contracts. So it shows they manage that supply chain risk pretty proactively.
Okay, good point. Before we get to the trade idea, there was a major positive cash benefit sort of buried in the transcript, the U.S. tax situation.
Oh yeah, very noteworthy for the cash flow enthusiasts out there. They reported a positive cash impact of $100 million in Q3 alone.
It's from tax.
Yeah, this resulted from accelerated 100% tax depreciation on U.S. projects, thanks to the Build Back Better legislation. It's a clear, probably one-off cash flow win that just shores up their financial strength for all those heavy investments they're making.
Okay, useful tailwind. Finally, let's talk policy, the external catalyst that could potentially turbocharge that backlog, the EU's upcoming Carbon Border Adjustment Mechanism, or CBAM.
Okay, now this is where it gets really interesting for the long term, I think. CBAM is essentially, a tax on carbon-intensive goods imported into the EU.
Right.
Management views this as a net positive. They argue it's going to drive decarbonization opportunities, not just inside Europe, where they already dominate, but critically, it forces foreign manufacturers, particularly in heavy industry. In places like China, the Middle East.
The big emitters outside the EU.
Exactly. It forces them to accelerate cleaning up their processes if they want to maintain access to the very lucrative EU market.
So CBAM effectively acts as a global accelerant, potentially forcing their non-European customers to buy Air Liquide's clean energy solutions and industrial gases sooner than they might have otherwise planned. That sounds like, well, a dream scenario for converting that €5 billion backlog.
It directly connects their strategy to global policy shifts. Air Liquide seems perfectly positioned to capture that new policy-driven demand globally, particularly in things like hydrogen and carbon capture.
Okay, we've covered the numbers, the strategy, the huge investments, and this potentially massive policy tailwind. Now it's time for our This Is Not Financial Advice segment. We pitch an outrageous but plausible trade idea based on the color from the earnings call.
All right, our trade premise today is pretty simple. Long Air Liquide fueled by nonlinear backlog conversion catalyzed by CBAM.
Okay, nonlinear. That implies a sudden positive surprise in how fast that backlog turns into revenue. Walk us through the rationale and the specific catalyst you're looking for.
All right, the market seems too focused on management's kind of cautious macro tone right now. But the structural signals, they just seem too strong to ignore. That $4.9 billion backlog, the $8 billion total capital deployment, those are the real signals, I think. The stock seems to be discounting the conversion of that backlog as slow and steady.
Just predictable growth.
Predictable, linear growth.
Yeah.
Our thesis is that the combination of their own self-help efficiencies, which are already running super hot, plus this external policy pressure from CBAM, will force non-European heavy industry to accelerate their final investment decisions, their FIDs on decarbonization projects, much faster than expected.
So we're basically betting on policy-induced urgency translating directly into major new contracts being signed sooner rather than later.
Exactly. Management specifically mentioned active discussions in the cement industry and regarding RFNBO hydrogen. So we're looking for the announcement of a single, large, high-return contract win, probably in a non-EU high-margin territory like the Middle East or maybe China, that is directly linked to CBAM compliance. That kind of announcement would signal that the policy is actually working and working faster than the market currently expects. It would dramatically accelerate the perceived conversion rate of that existing backlog way beyond the current sort of 310 million expectation for 2025. That kind of shift could drive a significant re-rating of the stock.
That makes sense, betting on the external policy pressure rather than just hoping for internal market growth to pick up. What's the major risk to that trade?
The major risk is pretty straightforward, the global macro environment. specifically high interest rates, geopolitical uncertainty,
Hmm.
anything that causes customers to simply defer those big final investment decisions.
So the backlog stays a backlog.
Exactly. That record backlog, while really impressive on paper, just sort of languishes longer than anticipated. The growth potential remains trapped for maybe another few years, and the catalyst doesn't materialize near term.
Okay, to quickly recap for everyone listening, Air Liquide's Q3 was really defined by flawless operational execution. We saw record efficiencies, steady pricing power, and this unprecedented investment backlog that management is clearly positioning as their structural foundation for the next 5 years or so.
Yeah, so the key question you, the listener, need to mull over is this. Can the group's internal self-help levers those efficiencies and pricing actions? Can they indefinitely counteract potentially sluggish underlying volume trends in large industry? Or does the success of that monumental $5 billion backlog actually depend entirely on global policy momentum, like CBAM, translating to accelerated nonlinear FIDs?
That's definitely a fascinating thought to explore. Thank you for joining us on this deep dive. Now go forth and form your own conclusions.